Hi everyone, so we're going to talk about deferred income taxes, and first we're going to do a bit of a review of what it is, and then we're going to get into how does it apply to consolidation. So just as a bit of an intro, so what do you guys think? So just because a tax treatment is different than accounting treatment, do you think that that means that we should have wild swings in our income tax expense? So we want to consider our principles, right? Matching, representational faithfulness, and relevance. And what does that tell us? It tells us that we should be trying to match our expenses with our revenues. So the goal of future income taxes or deferred income taxes is to match the tax effects to the same period as the accounting transaction occurs, because we know accounting treatment and tax treatment of certain items are not always the same, and they can result in what we call a temporary difference. So a temporary difference is where the tax basis of an asset or a liability is different from its accounting basis. So common examples are CCA and depreciation, the tax and the accounting treatment of a warranty liability. They are very different, and so they can result in what we call a temporary difference, which is going to result in a deferred income tax. So when our carrying amount, our accounting value of the assets are less than the tax base, this is going to result in a deferred income tax asset. If the accounting value of the assets is greater than the tax base, it's going to result in a deferred income tax liability. So let's look at a quick example. We've got a company, they have the following information. They purchased equipment in year one for $60,000. They have CCA at 20% per year. We're ignoring the half-year rule. And they calculate depreciation for straight line over 6 years. Their net income in year one is $30,000. So for year one and year two, we're going to want to show the calculation of our DIT, the entry, and we're going to be using the balance sheet approach, which is what we did in intermediate accounting. So let's get started. So you can see I've got our template set up. This should look familiar. And so here we're just going to calculate what is our closing balance. So 2018, we purchased this equipment, so our cost was $60,000. It was $60,000 under the tax and the accounting basis. In our CCA, we're calculating CCA at 20%. So we're just going to go ahead and we're going to take 20% of that balance. So our closing balance is at $60,000 less our CCA. So for tax basis, our closing balance is $48,000. So for the accounting basis, we're using straight line over 6 years. So we're going to have $10,000 of depreciation. So our closing balance is going to be $50,000. I'm just going to go ahead and format this so it's a little bit easier to look at here. So we can see that there is absolutely a difference. So our tax basis we know is $48,000. Our accounting basis is $50,000. Really important to keep our debits and our credits straight. Our temporary difference is calculated by taking the tax basis less the accounting basis. And our tax rate, this is example number 8 in your notes, is 40%. So our DIT balance that we're requiring is going to be this $2,000 credit difference times the 40%. So we know we need to have a balance, a credit balance of $800. But we need to consider what's our opening balance. Well, this is the first year, so our opening balance is 0. So our adjustment, we're going to take by doing our DIT balance required less our opening adjustment, is going to be $800. So if we scroll down now to our 2019, our opening balance is going to be what our closing was in 2018. So $48,000 and $50,000. Our CCA, we're going to calculate still 20%. So 20% of that 48,000. So our closing balance in 2019 is going to be 38,400. Accounting basis, we are still calculating straight line over 6 years from when we purchased the asset. So another $10,000 of depreciation. And so the closing value for the accounting basis is 40,000. So when we're filling out our chart, very important to get the columns in the correct order. Our tax basis, 38,400. Our accounting basis, 40,000. They're debits because that is what they sit on the balance sheet. It's an asset, so it would be a debit. So it's a debit in our chart. Our temporary difference, we're taking tax less the accounting. We still have a 40% tax rate. So our DIT balance that we are required to have is that 1,600 times the 40%. So we need 640, but we have an opening balance. Our opening balance is $800 credit. So we know we need to have an adjustment. So we take the difference between the two. And so we're going to need a debit of $160. So if we were wanting to go ahead and do the journal entries for 2018, we would be debiting our DIT expense benefit for $800 and crediting our DIT liability for $800. If we come and scroll down here to 2019, we need to have a debit to that asset account. So we're going to debit our DIT liability for the 160. Oops. And we're going to credit our DIT expense benefit for that 160 to make that adjustment. So how does deferred taxes play into our business combination and our consolidation? Well, IAS 12 requires application of DIT. So at acquisition, we need to record our subs and assets and liabilities at fair value, but their tax values are not going to be the same as their accounting values. So this creates a DIT at acquisition. So our major effects are it's going to change the goodwill amount. It's also going to have an ongoing change as the amortization of the acquisition differential occurs. So the DIT will need to be amortized in step 2 as well as the assets and the liabilities. So we're going to do another example in class. And so DIT and business combinations, we're only going to be dealing with this at the acquisition point of the consolidation.